Hey there! We have all heard about bonds. Many of us also know that they give better returns than fixed deposits. Yet, many of us haven't tried investing in bonds. Sometimes we feel it's risky, sometimes it seems too complicated, and other times, we're just not sure if it's worth the effort. In this video, we'll break down everything about bonds, what they are, why they're a good investment, the different types, the risks to consider, and how you can invest in them. Let's get started. Why even bother with bonds? You might be thinking that fixed deposits are a simpler and just as safe for getting stable returns. So, what are the potential downsides or limitations when we compare them to bonds? That's a fair question about safety. Here's something important to keep in mind about your bank deposits. They are insured by the Deposit Insurance and Credit Guarantee Corporation, DICGC, up to Rs 5 lakh per depositor, across all accounts in a single bank, covering both principal and interest. What happens if you have more than 5 lakh rupees deposited in a single bank and, unfortunately, that bank faces a serious financial crisis or even defaults? In such a scenario, while the DICGC will step in to cover you up to 5 lakh rupees, any amount exceeding that limit might be at risk. You could potentially lose a portion of your hard-earned money. This is where bonds, particularly those issued by financially sound entities or the government, can offer a different kind of safety and potential for higher overall returns on larger sums, even when considering the inherent risks of each bond type. They offer regular interest payments and are generally considered safer than stocks. Plus, they help balance your investment portfolio, making sure you're not putting all your eggs in one basket. What exactly are bonds? Imagine someone needs to borrow money. It could be the government or a big company. Instead of going to a bank, they can ask people like us to lend them money by issuing bonds. Now, let's dive into the key players and terms. First, we have the issuer. This is the entity that creates the bond to raise funds. Next, the investor. That's you, the individual or institution that buys the bond. By doing so, you're essentially lending your money to the issuer in exchange for periodic interest payments. Speaking of face value, this is the amount you'll get back once the bond matures. Then, there's the coupon rate. Think of it as the bond's interest rate. It's a percentage of the face value that you'll receive as income, usually paid semi-annually. Moving on to the maturity date. This is the date when the bond's term ends and the issuer returns the face value to the investor. Finally, we have yield to maturity. A bit more complex, but crucial. It represents the total return expected if the bond is held until maturity. Understanding these terms is your first step in navigating the bond market confidently. Simple as that. Bonds come in different flavors. Here are the main types. First is government bonds, GSECs. Government bonds are considered a very safe investment as they are issued by the central government to fund public projects like infrastructure development. The likelihood of default is extremely low due to the government's backing. To cover short-term financial obligations, governments issue treasury bills, T-bills. These are debt securities with maturities of less than a year, offering investors a low-risk way to lend to the government. Then there's state government bonds, also called state development loans, SDLs. Similar to government bonds, but issued by individual state governments to fund this fiscal deficit. Each state can borrow up to a set limit. They might be a tiny bit riskier than the central government ones, but still pretty safe. Next, there's company bonds, also known as corporate bonds. Big companies issue these to get money for their businesses. These can be a bit riskier than government bonds because, companies can sometimes face tough times. But because of that higher risk, they often offer you a bit more interest. Next up is government company bonds, or public sector undertaking bonds. These bonds are issued by government-owned or government-controlled companies to raise capital. They usually fall somewhere in between regular government bonds and private company bonds in terms of risk. Then there's gold bonds, also called sovereign gold bonds, or SGBs. These are a cool way to invest in gold without actually holding physical gold. The government issues them, and they also pay you a bit of interest on top of the gold price changes. However, the government is considering to close the sovereign gold bond scheme in 2025. Earlier issues are available in the secondary market. It's difficult to give precise return figures as they constantly fluctuate. However, here's a general idea of the potential returns you might expect from different types of bonds. G-SECs offer low returns. Yields can range from 6 to 8% per annum. SDLs give slightly higher yields ranging from 6.5 to 8.5% per annum. Corporate bonds offer wider range of returns from 7% to 12%. It goes without saying, bonds offering higher returns typically carry higher risks. We'll be shining a spotlight on the key risks associated with bonds a little later in the video. Now, let's look at taxation. Capital gains arise when you sell your bonds for a price higher than your purchase price. For bonds listed and traded on the stock exchange like NSE or BSE. If sold within 12 months from the date of purchase, the gains are taxed as per your applicable income tax slab rate. If sold after holding for more than 12 months, the gains are taxed at a flat rate of 10% without indexation. For sovereign gold bonds, interest income is taxed as per your income tax slab. Capital gains at maturity are exempt from tax for individuals. Tax rules are subject to change, so it's always advisable to consult a tax professional for the latest information and how it applies to your specific situation. Do you find this helpful? Share the knowledge with family, friends, and colleagues. And don't forget to like and subscribe for more such useful information. Checking the report card. Credit rating of bonds. How do you know if a company is likely to pay you back on their bonds? That's where credit ratings come in. Just like you've got a credit score that tells lenders how reliable you are with money, companies get their own report cards too. Rating agencies. There are special companies like CRISIL, ICRA, and CARE that check how good different borrowers, especially companies, are at paying back their debts. They give them a report card called a credit rating. Rating symbols. These agencies use a specific language, a system of symbols, to tell us exactly how they see the company's ability to pay back their debts. You'll see letters like AAA, AA, A, BBB, and so on. Let's understand what they mean. AAA. It means the company is considered extremely strong and has a very, very low risk of default. Basically, they're super reliable. AA. Still excellent. Very strong capacity to meet their financial commitments. A. Good, solid. They're capable of paying back their debts, but there's a slightly higher risk than AAA or AA ratings. BBB. This is where things start to get a bit more cautious. They're still considered investment grade, but they're more sensitive to economic changes. If things get tough, they might struggle a bit more. Anything below BBB like BB, B, CCC. These are considered non-investment grade or junk bonds. Finally, D rating indicates that the company has defaulted. Why it matters to you. Before you put your money in a company bond, always check its credit rating. It's all about finding the right balance of risk and reward for the investment. Bond risks. What you need to know. Once you've selected a bond based on its credit rating and your risk appetite, it's crucial to consider additional factors. Like any investment, bonds carry inherent risks that you should understand to make informed decisions. Here are the key risks. Default risk or credit risk. This is the risk that the borrower, whether it's a company or even the government, might not be able to pay you back your interest or the principal amount when it's due. Liquidity risk. This is the risk that you might not be able to sell your bond quickly or easily if you need to. This means you might have to wait a while to find a buyer or sell it at a lower price than you'd like. Government bonds are usually very liquid, meaning they are easy to buy and sell. Corporate bonds can vary. Interest rate risk. This is where things get a little more interesting. When interest rates in the market go up, the value of your existing bonds tends to go down. Why? Because new bonds will be issued with higher interest rates, making your older, lower-rate bonds less attractive. Conversely, when interest rates go down, the value of your existing bonds can go up. This risk is greater for bonds with longer maturity dates. This is an important factor to consider when you are thinking about how long you want to invest in bonds. When you're considering investing in bonds, Don't just look at the interest rate they offer. Factor in these risks as well. Alright, so you're convinced that bonds might be a good fit for your portfolio. The next logical question is, how do you actually buy and sell bonds? And is it as straightforward as dealing with stocks or mutual funds online? The good news is, yes, it's becoming increasingly easier to invest in bonds, and much of the process can be done online. There are a couple of different avenues you can explore. Let's first talk about the general process, which often involves what we call the primary and secondary markets. Primary market. This is where new bonds are issued for the very first time by companies or the government to raise money. Think of it like an IPO for stocks. You can subscribe to these new bond offerings when they become available. Secondary market. Once a bond has been issued, it can be bought and sold between investors on the secondary market, much like how stocks trade on exchanges like the NSE and BSE. Now, you might be wondering, can you easily find all the important details about a bond in one place to help you decide if it's the right investment for you? Absolutely. The financial landscape has evolved, and there are now several online platforms and resources that bring together crucial information about bonds, making your decision-making process much smoother. For instance, specialized websites. Websites like thefixedincome.com are dedicated to providing information and access to various fixed income instruments, including bonds. Dedicated investment apps. Apps like Wint Wealth have emerged, specifically designed to make bond investing more accessible to retail investors, offering detailed information and a user-friendly interface. Brokerage platforms. Established brokers like ICICI Direct.com also provide platforms for buying and selling bonds, often integrated with their other investment offerings. The key thing to remember when using these platforms for most corporate bonds is that you will typically need a demat account. Just like when you buy stocks, the bonds you purchase through these platforms will be held electronically in your demat account. This is a standard requirement for trading securities in India. However, there's another fantastic option, especially for investing directly in government bonds, and it simplifies things even further: the RBI Retail Direct Scheme. Launched by our central bank, the Reserve Bank of India, RBI, this scheme is a game-changer for retail investors. While a demat account isn't required for RBI Retail Direct, you will need a savings bank account that's linked to your PAN, along with other standard KYC, Know Your Customer, documents to open your RDG account with the RBI. It's all part of ensuring a secure and compliant investment process. It allows you to directly invest in government securities, G-Secs, and short-term treasury bills, T-bills, without needing to go through a broker or any other intermediary. You'll need to open what's called an RDG account directly with the RBI through their dedicated online platform. It's a separate account you create with the RBI. And here's a significant advantage. You do not need a demat account to invest in government securities via the RBI Retail Direct platform. This makes it even more accessible for many investors. So, whether you choose to explore the broader bond market through online platforms and your demat account, or you prefer the direct route for government securities via the RBI Retail Direct Scheme, there are increasingly user-friendly ways for you to participate in the world of bonds. In conclusion, bonds play a vital role in a well-diversified investment portfolio by providing stability, regular income, and capital preservation. Do your due diligence, understand the risks involved before investing. If necessary, consider consulting a financial advisor to determine the best bond strategy for your individual financial goals. Let us know in the comments below if you have any questions about bonds. Happy investing, and we'll see you in the next video.